Tonight, we trace the evolution of one of humanity's most transformative inventions. Not fire, not the wheel, not even writing, but something more abstract, more purely human: money. That strange social agreement that allows us to exchange our time and labor for pieces of metal, scraps of paper, or increasingly numbers on a screen. Money seems so natural, so essential to modern life, that it's hard to imagine the world without it. But for most of human existence, money didn't exist. And the journey from a moneyless world to our current system of global finance is a fascinating story of human ingenuity, trust, and social evolution. Close your eyes and imagine a world without money. No coins jingling in pockets, no bills folded in wallets, no bank accounts, no credit cards, no price tags. How would you get what you need? How would you trade your skills or labor for food, clothing, shelter? This was the reality for humans for hundreds of thousands of years. Our ancestors were hunter-gatherers living in small bands, sharing resources within the group. There was no need for money because there was no trade in the modern sense. Everyone in the band contributed to survival, and everyone shared in the results. But as human societies grew larger and more complex, as people began to specialize in different tasks, as communities started trading with one another, a problem emerged. How do you exchange goods and services fairly when not everyone wants what you have to offer? If you're a fisherman who needs pottery, but the potter doesn't need fish, how do you make a trade? You need something the potter wants. This is called the double coincidence of wants, and it's the fundamental problem that money solves. Before money, people used barter, direct exchange of goods and services. Barter works fine in simple situations. If you have grain and need meat, and your neighbor has meat and needs grain, you can trade. But barter becomes complicated quickly. What if you need a tool but only have grain to trade, and the tool maker doesn't need grain? You'd have to find someone who wants grain and has something the tool maker wants, then make multiple exchanges. Barter is inefficient, limiting trade and economic development. Some societies used forms of commodity money, items with intrinsic value that everyone wanted. In many cultures, these commodities served as early forms of money. Cattle were used in ancient societies, so common that the Latin word for money, pecunia, comes from pecus, meaning cattle. But cattle aren't ideal money. They're difficult to divide. You can't pay for bread with half a cow. They're perishable. They require care and feeding. They vary in value depending on age, health, and size. Other commodities worked better. Salt was valuable enough to serve as money in some societies. The word salary comes from sal, Latin for salt, because Roman soldiers were sometimes paid in salt. Grain, cloth, tools, and weapons all served as commodity money in various cultures. Each had advantages and disadvantages. Grain is divisible and relatively standard, but it can spoil. Cloth is portable and divisible, but it can deteriorate. The search for better forms of money continued. Some of the most interesting early forms of money weren't practical commodities, but items valued primarily for their beauty or rarity. Shells, particularly cowrie shells, were used as money in Africa, Asia, and the Pacific Islands for thousands of years. Cowrie shells are beautiful, durable, portable, and difficult to counterfeit. They came from specific regions, making them relatively scarce. Most importantly, people agreed they had value. This agreement, this collective belief that something is valuable because everyone else agrees it's valuable, is the essence of money. In the Americas, various indigenous peoples used wampum, beads made from shells, for both ceremonial purposes and trade. Wampum belts served as records of agreements and historical events, but individual beads also functioned as currency. The value came not from the shells themselves, but from the labor required to make the beads and the cultural significance attributed to them. In many Pacific islands, large stone discs called rye stones served as money. On the island of Yap, some rye stones were enormous, weighing several tons and standing taller than a person. These couldn't be moved easily, so ownership changed without physically moving the stone. Everyone in the community simply agreed on who owned which stone. This seems strange, but it's not so different from modern banking, where money mostly exists as electronic records rather than physical objects. The stone sits in the same place, but ownership changes through social agreement. Cacao beans served as money in Mesoamerican civilizations. The Aztecs and Maya used cacao beans for small transactions, making them a practical form of currency. The beans were valuable because they could be consumed as a luxury beverage, but they also circulated as money. This dual nature, useful commodity and medium of exchange, made them effective currency until Spanish colonization disrupted the system. These early forms of money shared common characteristics. They were scarce enough to have value, but available enough to circulate. They were durable, lasting long enough to serve as a store of value. They were portable, easy to carry from place to place. They were divisible, allowing for transactions of different sizes. And most importantly, they were accepted. People agreed they had value and were willing to trade goods and services for them. But all these forms of money had limitations. Shells could break, stones couldn't be transported, cacao beans could spoil, cattle required care. What people needed was something that combined the best features of all these early currencies: durable, portable, divisible, scarce, and universally desired. The answer, discovered independently by multiple cultures, was metal. Metals, particularly precious metals like gold and silver, made nearly ideal money. Gold and silver are beautiful, don't corrode or decay, can be divided into any size, are rare enough to be valuable, but common enough to circulate, and have inherent value for jewelry and decoration. By around 3000 BCE, gold and silver were being used as measures of value in Mesopotamia and Egypt, though not yet in standardized coin form. The earliest metal money was simply weighed pieces of precious metal. When you bought something, you'd cut off a piece of silver or gold, weigh it, and give it to the seller. This worked but had problems. Weighing took time. The purity of the metal varied. Disputes arose over whether the metal had been properly weighed or if it was alloyed with cheaper metals. What was needed was standardized pieces of metal, guaranteed to have a certain weight and purity. What was needed were coins. The invention of coinage around 600 BCE in the Kingdom of Lydia in what is now Turkey was revolutionary. Lydian coins were made of electrum, a natural alloy of gold and silver, stamped with the king's seal. This stamp guaranteed the coin's weight and purity, backed by the king's authority. No more weighing metal for each transaction. No more disputes about purity. The coin itself, bearing the royal seal, was the guarantee. Coinage spread rapidly. Greek city-states adopted it, each minting their own coins with distinctive designs. Athens produced silver coins with an owl, symbol of the goddess Athena. These coins were so reliable and widely accepted that they circulated throughout the Mediterranean world. Persian kings minted gold coins, called darics, decorated with an image of the king holding a bow. These coins spread across the vast Persian Empire, facilitating trade from Egypt to India. Coins transformed economies. They made trade easier and more efficient. They allowed for more complex economic relationships. They enabled the accumulation of wealth in a portable, secure form. But coins also changed society in deeper ways. The images on coins became powerful propaganda tools. Every time someone used a coin, they saw the ruler's image, reinforcing royal authority. Coins spread not just economically, but culturally, carrying images, ideas, and language across trade networks. The Romans took coinage to new levels of sophistication. Roman coins circulated throughout their vast empire, from Britain to Mesopotamia. The denarius, a silver coin, became the standard currency, so widely used that its name survives in various modern currencies. The dinar in Arabic countries, the denier in France. Roman coins bore images of emperors, military victories, temples, and gods, serving as miniature billboards spreading imperial ideology. But even Rome faced monetary challenges. As the empire grew, maintaining the silver content of coins became difficult. Emperors began debasing the currency, mixing in cheaper metals while maintaining the face value. This caused inflation. Prices rose because each coin contained less actual silver. By the 3rd century CE, the denarius had lost most of its silver content. This monetary instability contributed to the empire's economic troubles and eventual decline. The fall of Rome disrupted the monetary system in Western Europe. Trade declined, cities shrank, and the economy became more localized. Coinage became less common. Many regions returned to barter or used limited local currencies. This period, often called the Dark Ages, saw the loss of much economic sophistication that Rome had achieved. But monetary development continued elsewhere, particularly in China and the Islamic world. China had been using metal tools and weapons as commodity money for centuries. By around 1000 BCE, small bronze implements shaped like spades and knives circulated as currency. These eventually became more abstract, keeping the shape but losing the function. Early coins. By 221 BCE, when China unified under the Qin dynasty, Emperor Qin Shi Huang standardized the currency, making round coins with square holes that could be strung together. This design, practical and elegant, remained standard in China for over 2,000 years. Chinese coins spread throughout East Asia, influencing monetary systems in Korea, Japan, and Southeast Asia. The Chinese system was sophisticated, with different denominations for different transaction sizes. But China's greatest monetary innovation came much later, the invention of paper money. Paper money emerged in China during the Song dynasty, around the 11th century CE. Merchants, tired of carrying heavy coins for large transactions, began depositing coins with trusted parties who issued paper receipts. These receipts, promising to pay the bearer a certain amount of coins on demand, began circulating as money themselves. Why carry heavy coins when you could carry a light paper note that represented those coins? The Chinese government recognized the potential and began issuing official paper money, backed by precious metals held in reserve. This was revolutionary. Paper money was much lighter than coins, easier to produce, and harder to steal in large quantities. The government could more easily control the money supply, but paper money also introduced new risks. What if the government printed more notes than it had metal to back them? What if people lost confidence in the paper and demanded their coins back? These risks became reality. Chinese dynasties sometimes printed too much paper money, causing inflation and economic disruption. When the Mongol Yuan dynasty collapsed in the 14th century, people's faith in paper money collapsed with it. China returned to metal coinage for several centuries. The experiment with paper money had failed, at least temporarily. Meanwhile, in the Islamic world, monetary development continued along different lines. Islamic law prohibited lending at interest, which complicated banking. But Islamic merchants needed ways to transfer money across long distances safely. They developed sophisticated systems of bills of exchange, written orders to pay a certain amount in a different location. A merchant in Cairo could deposit money with a banker and receive a letter instructing a banker in Baghdad to pay the equivalent amount. This allowed long-distance trade without physically transporting coins. Medieval Europe eventually rediscovered these techniques, partly through contact with the Islamic world during the Crusades. Italian city-states, particularly Venice, Florence, and Genoa, became banking centers. Italian bankers developed double-entry bookkeeping, letters of credit, and bills of exchange. The Medici family of Florence became so wealthy through banking that they effectively ruled the city and patronized artists like Michelangelo and Leonardo da Vinci. European banking evolved gradually. Goldsmiths, who had secure vaults for storing gold, began accepting deposits and issuing paper receipts. These receipts, like Chinese paper money, began circulating as currency. The goldsmiths realized they didn't need to keep all the deposited gold in their vaults. People rarely redeemed all their receipts at once. The goldsmiths could lend out some of the gold, earning interest as long as they kept enough in reserve to meet normal demand. This was fractional reserve banking, the basis of modern banking systems. But this system required trust. If everyone simultaneously demanded their gold back, a bank run, the goldsmith couldn't pay. The bank would fail, and depositors would lose their money. Maintaining trust became crucial. Banks that managed conservatively, keeping adequate reserves and making sound loans, earned reputations for reliability. Banks that overextended failed, sometimes spectacularly, causing economic disruption. European monarchs also influenced monetary development. Kings needed money to fund wars, build palaces, and pay administrators. They could raise taxes, but this was unpopular and limited. They could debase the currency, mixing cheaper metals into coins, but this caused inflation and reduced trust. Increasingly, kings borrowed money from bankers and merchants, promising to repay with interest. National debt was born, creating complex relationships between governments and financial institutions. The Bank of England, founded in 1694, pioneered central banking, created to help the English government borrow money to fight wars. The Bank of England issued banknotes backed by government bonds. These notes circulated as currency, accepted because of the government's guarantee. This established a pattern: central banks issuing currency backed by government authority that most countries would eventually follow. Paper money gradually became accepted in Europe. At first, people were skeptical. Paper seemed too flimsy, too easy to forge. But paper money's convenience eventually won out. Governments learned that maintaining the currency's value required discipline. Print too much money, and inflation would erode trust. Maintain sound monetary policy, and people would accept paper money as readily as gold and silver coins. The 18th and 19th centuries saw the rise of the gold standard. Countries defined their currencies in terms of gold, promising to exchange paper money for gold at a fixed rate. The gold standard provided stability and confidence. You knew that your paper money represented a specific amount of actual gold. This made international trade easier. Currencies could be exchanged based on their gold values. But the gold standard also constrained governments. They couldn't simply print more money when needed because they had to maintain enough gold reserves to back the currency. The Industrial Revolution transformed economies and monetary systems. Industrialization required massive capital investments: factories, railroads, machinery. Traditional banking couldn't provide enough capital. New financial institutions emerged: investment banks, stock markets, insurance companies. Money became increasingly abstract, represented not just by coins or paper, but by stocks, bonds, and other financial instruments. Stock markets allowed companies to raise capital by selling shares, pieces of ownership that could be bought and sold. The Amsterdam Stock Exchange, founded in 1602, was the world's first modern stock exchange. It allowed investors to buy and sell shares in the Dutch East India Company. This innovation spread to other countries. By the 19th century, major cities had stock exchanges where shares in companies, bonds from governments, and other financial instruments traded daily. Stock markets introduced new dynamics. Prices fluctuated based on supply and demand, on news and rumors, on hopes and fears. Bubbles formed when enthusiasm drove prices far above realistic values. Crashes occurred when fear caused panics. The South Sea Bubble in England in 1720 saw stock prices soar on speculation about trading profits from the South Seas, then crash when reality didn't match expectations. Thousands of investors lost fortunes. Similar bubbles and crashes have occurred repeatedly throughout financial history. Banking became more sophisticated and more integral to economic life. Banks didn't just store money, they created it through lending. When a bank makes a loan, it credits the borrower's account with money, effectively creating money that didn't exist before. When the loan is repaid, that money disappears. This money creation through lending is fundamental to fractional reserve banking and modern monetary systems. It allows the money supply to expand and contract based on economic needs, but it also requires careful regulation to prevent instability. The late 19th and early 20th centuries saw financial crises caused by bank failures and monetary instability. The Panic of 1907 in the United States, triggered by failed speculation and bank runs, led to calls for banking reform. This eventually resulted in the creation of the Federal Reserve System in 1913, establishing a central bank to regulate money supply, act as lender of last resort to banks, and stabilize the financial system. But the gold standard became problematic in the 20th century. During World War I, countries needed to print money to fund military spending beyond what their gold reserves supported. Most countries suspended gold convertibility during the war. After the war, many tried to return to gold, but at different rates, causing economic distortions. The Great Depression of the 1930s was exacerbated by gold standard constraints. Countries that abandoned gold earlier recovered faster because they could expand money supply and stimulate their economies. The United States formally abandoned the gold standard for domestic transactions in 1933, though dollars remained convertible to gold for international transactions. The Bretton Woods system, established in 1944 as World War II ended, created a new international monetary order. The US dollar would be convertible to gold at a fixed rate, and other currencies would be pegged to the dollar. This made the dollar the world's reserve currency, the currency used for international trade and held by foreign governments as reserves. The Bretton Woods system worked for a few decades, facilitating post-war economic recovery and growth. But by the late 1960s, the system faced strains. The United States printed more dollars than its gold reserves could support, funding domestic programs and the Vietnam War. Foreign governments, particularly France, began demanding gold for their dollars, draining US gold reserves. In 1971, President Richard Nixon ended dollar convertibility to gold, effectively ending Bretton Woods. Since then, major currencies have floated freely, their values determined by market forces rather than fixed exchange rates or gold backing. Modern money is fiat currency, money that has value because the government declares it legal tender and people accept it, not because it represents any commodity. Paper dollars, plastic polymer notes, electronic entries in bank computers, all are fiat money. Their value derives from trust in the issuing government and confidence that others will accept them. This seems fragile, but it works. Governments that maintain sound monetary policy, control inflation, and foster economic stability maintain their currency's value. Governments that print money recklessly or face political instability see their currencies lose value, sometimes catastrophically. Hyperinflation demonstrates what happens when fiat currency loses value. Germany in the 1920s experienced hyperinflation, so severe that prices doubled every few days. Workers were paid multiple times daily and rushed to spend their wages before they became worthless. Wheelbarrows of cash were needed to buy bread. Zimbabwe in the 2000s faced similar hyperinflation, with prices doubling daily and trillion-dollar notes becoming worthless. Venezuela in recent years has experienced hyperinflation destroying the economy. These examples show that money requires trust and sound management. Without these, even officially issued currency becomes worthless paper. Credit cards, introduced in the mid-20th century, represent another evolution in money. A credit card isn't money itself, but a promise to pay, backed by the issuing bank. When you use a credit card, the bank pays the merchant, and you owe the bank. This allows transactions without immediate payment, extending credit broadly through society. Credit cards make transactions convenient. no need to carry cash, and provide purchase protection, but they also enable debt accumulation, with high interest rates trapping some consumers in debt spirals. Computerization transformed banking and finance in the late 20th century. Electronic funds transfers replace physical checks and cash for many transactions. Direct deposit of paychecks, automatic bill payments, wire transfers between banks all became routine. Money increasingly existed not as physical objects, but as electronic records in computer databases. When you check your bank balance online, you're seeing numbers in a database, not counting physical bills or coins. ATMs, automated teller machines, revolutionized access to cash. First introduced in the 1960s, ATMs allowed people to withdraw money from their accounts 24/7 without visiting a bank during business hours. ATM networks expanded globally, allowing travelers to access their money anywhere in the world. This convenience came with new risks: card skimming, PIN theft, and fraud, requiring ongoing security innovations. Electronic payment systems evolved rapidly. Debit cards, linked directly to bank accounts, combined the convenience of credit cards with the discipline of cash. Unlike credit cards, debit cards deduct money immediately from your account. Online banking, emerging in the 1990s, allowed people to manage their accounts, pay bills, and transfer money from home computers. Mobile banking, developing in the 2000s, brought banking to smartphones, allowing financial transactions anywhere, anytime. These technologies spread globally but unevenly. Developed countries adopted electronic payments rapidly, with cash becoming less common. In some Scandinavian countries, cash transactions are now rare, with most people paying electronically even for small purchases. But in many developing countries, cash remains dominant, and many people lack bank accounts. This financial exclusion leaves billions without access to formal financial services. Mobile money emerged as a solution for financial inclusion, particularly in Africa. M-Pesa, launched in Kenya in 2007, allows people to send money via mobile phone without needing a bank account. Users deposit cash with agents, receiving electronic credits they can transfer to others or spend at participating merchants. This innovation has transformed economies in countries where banking infrastructure is limited. Millions of previously unbanked people now have access to financial services through their phones. Meanwhile, in developed countries, the 2008 financial crisis shook confidence in traditional banking, caused by excessive risk-taking, particularly in mortgage lending. The crisis led to bank failures, government bailouts, and a severe recession. Many people lost homes, jobs, and savings. Trust in financial institutions declined. This environment of distrust and technological innovation created conditions for a radical new form of money: cryptocurrency. Bitcoin, created in 2009 by an anonymous person or group using the name Satoshi Nakamoto, introduced the concept of decentralized digital currency. Unlike traditional money controlled by governments and banks, Bitcoin operates on a distributed network of computers with no central authority. Transactions are recorded on a public ledger called the blockchain, maintained collectively by network participants through cryptographic verification. The blockchain is a revolutionary technology. It creates a permanent, tamper-proof record of all transactions without requiring a trusted central authority. Each transaction is verified by network participants, bundled with other transactions into a block, and added to the chain of previous blocks. Once recorded, transactions can't be altered or deleted. This solves a fundamental problem of digital money, preventing the same digital currency from being spent twice, without relying on a central authority to verify transactions. Bitcoin's value derives not from government backing or commodity reserves, but purely from supply and demand. The Bitcoin system limits the total supply to 21 million coins, creating scarcity. Demand comes from people who believe Bitcoin has value as a medium of exchange, a store of value, or an investment. Bitcoin's price has been extremely volatile, surging from pennies to tens of thousands of dollars per coin, with dramatic crashes along the way. Bitcoin inspired thousands of other cryptocurrencies, alternative coins, or altcoins. Ethereum, created in 2015, added programmable smart contracts to blockchain technology, enabling decentralized applications and complex financial transactions. Litecoin, Ripple, Cardano, and countless others offer variations on the cryptocurrency concept, with different technical features, governance structures, and purposes. Cryptocurrency advocates envision a financial system without banks or government control. Proponents argue that cryptocurrency is more democratic, more accessible, more resistant to censorship and inflation. Critics point to cryptocurrency's volatility, its use in illegal activities, its massive energy consumption for transaction verification, and its potential to destabilize conventional financial systems. Governments and central banks remain ambivalent, sometimes hostile, toward cryptocurrency, though some are exploring issuing their own digital currencies. Central bank digital currencies, or CBDCs, represent government's response to cryptocurrency. Unlike decentralized cryptocurrencies, CBDCs would be issued and controlled by central banks, just like traditional currency but in digital form. China has piloted a digital yuan. The European Central Bank is developing a digital euro. Several other countries are exploring CBDCs. These would combine cryptocurrencies' technological advantages: fast, cheap transactions, programmability, with traditional money stability and government backing. The debate over cryptocurrency's future continues. Will it revolutionize finance, replacing traditional banking? Will it remain a niche technology for enthusiasts and speculators? Will governments regulate it heavily or embrace it? Will it coexist with traditional money, serving specific purposes? These questions remain open. What's clear is that cryptocurrency has introduced new possibilities and challenges for monetary systems. Payment systems continue evolving. Mobile payment apps like Venmo, PayPal, and Cash App allow instant peer-to-peer money transfers. Buy now, pay later services let consumers split purchases into installments without credit cards. Cryptocurrencies enable borderless transactions without currency exchange. Each innovation makes transactions easier, but also introduces new risks and challenges: security, privacy, fraud, regulation. Contactless payments using technologies like NFC chips in credit cards and smartphones have become widespread, accelerated by the COVID-19 pandemic's emphasis on minimizing physical contact. People can pay by tapping their card or phone without handling cash, or touching payment terminals. This convenience has further reduced cash usage, particularly for small transactions. Stablecoins attempt to combine cryptocurrencies' technological benefits with traditional money's stability. These cryptocurrencies are pegged to stable assets, like the US dollar, maintaining relatively constant value rather than fluctuating wildly. Tether, USD Coin, and others claim to hold reserves backing each digital coin's value. Stablecoins could facilitate cryptocurrency transactions without extreme volatility, but they raise questions about reserves, backing, and regulation. The concept of money has expanded beyond traditional currency. Loyalty points from airlines and retailers function as private currencies, redeemable for goods and services. Virtual currencies in online games have real-world value, with players buying and selling game currency for traditional money. Social media platforms experiment with tipping features using digital tokens. Money's definition becomes increasingly broad and complex, yet fundamental concepts remain. Money serves three basic functions: medium of exchange, unit of account, and store of value. As a medium of exchange, money facilitates transactions, allowing people to trade without barter's difficulties. As a unit of account, money provides a standard measure of value, allowing us to compare prices and make economic calculations. As a store of value, money allows us to save, to preserve wealth for future use. Good money should be durable, lasting without deteriorating. It should be portable, easy to carry and transfer. It should be divisible, allowing transactions of various sizes. It should be uniform, with each unit identical to others. It should be scarce or limited in supply, maintaining value. And it should be acceptable, widely recognized, and trusted. Different forms of money throughout history have balanced these characteristics differently. Trust underlies all money systems, whether cowrie shells, gold coins, paper notes, or Bitcoin. Money works because people trust it will be accepted by others. This trust can be based on intrinsic value. Gold is valuable for jewelry. It can be based on government backing. Legal tender laws require acceptance. It can be based on network effects. Widely used currencies become more valuable through acceptance. But without trust, money fails. The evolution of money reflects human social and cognitive development. Money is a sophisticated social technology requiring abstract thinking, trust in strangers, and complex cooperation. The ability to use symbols, shells, coins, paper, numbers to represent value demonstrates cognitive advancement. The willingness to accept these symbols requires social trust and shared understanding. Money is as much psychological and social as economic. Money has transformed human societies. It enabled economic specialization. People could focus on particular skills, trading their products or services for money, then using money to buy what they needed. This specialization increased productivity and innovation. Money facilitated trade over long distances between strangers who had no social relationship. This expanded economic networks, allowing resources and goods to flow across regions and continents. Money also enabled capital accumulation and investment. People could save money and invest it in productive enterprises. Entrepreneurs could borrow money to start businesses. This financial capital enabled economic growth on scales impossible with barter systems. The Industrial Revolution required massive capital investments that only sophisticated monetary and financial systems could provide. But money also created new forms of inequality and social problems. Accumulation of wealth became possible at scales that generated vast disparities. Those who controlled money and credit gained power over those who didn't. Debt relationships created dependencies and sometimes exploitation. The pursuit of money became a dominant motivation, sometimes overriding other values. Money's benefits came with social costs. Financial crises repeatedly disrupt economies. Throughout history, credit booms have led to speculative bubbles, followed by crashes causing economic hardship. The Panic of 1819, the Panic of 1873, the Panic of 1907, the Great Depression of the 1930s, the 2008 financial crisis. Each caused unemployment, business failures, and suffering. These crises reveal money system fragility and the need for careful regulation. Monetary policy, government and central bank decisions about money supply and interest rates profoundly affects economies. Expanding money supply can stimulate economic activity, but risks inflation. Contracting money supply can control inflation, but risks recession. Central banks must balance these competing concerns, making decisions affecting millions of people's economic well-being. These decisions are technically complex and politically contentious. Inflation gradually erodes money's value. Over time, prices rise and money buys less. Moderate inflation is considered normal and even healthy in modern economies. But high inflation can be destructive, eroding savings and distorting economic decisions. Central banks typically target low, stable inflation, using interest rates and other tools to maintain price stability. Deflation, falling prices, seems beneficial but can be economically harmful. When prices fall, people delay purchases, expecting further declines. This reduces demand, causing businesses to cut production and lay off workers. Falling wages and employment further reduce demand, creating a downward spiral. This dynamic worsened the Great Depression. Central banks now actively try to prevent deflation. Exchange rates determine how much one currency is worth in terms of another. These rates fluctuate based on trade balances, interest rates, economic growth, political stability, and market expectations. Exchange rate movements affect international trade, tourism, investment, and debt. Currency trading is the world's largest financial market, with trillions of dollars exchanged daily, mostly by speculators, rather than for actual trade or investment. The US dollar's role as global reserve currency gives the United States significant economic advantages. International trade is often conducted in dollars. Foreign governments hold dollars as reserves. This demand for dollars allows the US to borrow more cheaply and run larger trade deficits than otherwise possible. But it also creates responsibilities. US monetary policy affects the global economy. Some countries resist dollar dominance, seeking alternatives, but the dollar remains dominant due to the US economy's size, stability, and financial markets' depth. Money laundering, disguising illegally obtained money as legitimate, is a persistent challenge. Criminals use complex transactions, shell companies, and international transfers to hide money's origins. Financial institutions must implement anti-money laundering procedures, verifying customers' identities and reporting suspicious transactions. But money laundering continues, facilitated by offshore financial centers, cryptocurrencies, and the global financial system's complexity. Tax evasion often involves hiding income or assets to avoid taxation, while legal tax avoidance uses legitimate strategies to minimize taxes. Tax evasion is illegal but widespread. Offshore accounts, shell companies, and cryptocurrency transactions can help conceal wealth. Governments lose substantial revenue to tax evasion, affecting public services and requiring higher taxes on honest taxpayers. Financial inclusion, ensuring everyone has access to financial services, remains a global challenge. Billions lack bank accounts, preventing them from saving safely, accessing credit, or participating fully in the formal economy. Distance from banks, documentation requirements, minimum balance requirements, and distrust of formal institutions contribute to financial exclusion. Mobile banking and microfinance offer solutions, bringing financial services to previously excluded populations. Microfinance provides small loans to poor people, often women, who lack collateral for traditional loans. This enables entrepreneurship and economic self-sufficiency. The Grameen Bank in Bangladesh, founded by Muhammad Yunus, pioneered microfinance, demonstrating that poor people are creditworthy and can use small loans productively. Microfinance has spread globally, though debates continue about its effectiveness and appropriate practices. Universal basic income, regular cash payments to all citizens without work requirements, is debated as a potential response to technological unemployment and poverty. Proponents argue it would reduce poverty, simplify welfare systems, and provide economic security as automation displaces workers. Critics worry about costs, work incentives, and inflation. Pilot programs in various countries test these ideas, though no major economy has implemented full universal basic income. The future of money is uncertain and exciting. Digital currencies, whether cryptocurrencies, central bank digital currencies, or private company currencies, will likely play larger roles. Cash will probably decline further, perhaps eventually disappearing in some countries. Financial technologies will continue making transactions faster, cheaper, and more convenient. But challenges remain. How do we ensure financial privacy while preventing crime? How do we provide financial stability while enabling innovation? How do we include everyone in the financial system? How do we regulate global, decentralized systems that cross national borders? How do we maintain monetary sovereignty as money becomes more globalized and privatized? These questions will shape financial systems' evolution. Money reflects human trust, creativity, and cooperation. Every form of money, from shells to coins to paper to digital currencies, required people to agree that something has value and to trust others will accept it. This shared social agreement, this collective belief, enables the complex economic systems supporting modern life. When trust breaks down, when people doubt money's value or the financial system's integrity, economic chaos can follow. Yet humans have repeatedly rebuilt trust and created new monetary systems after collapses. After hyperinflation destroyed Germany's currency in the 1920s, Germany rebuilt with a new, stable currency. After World War II devastated economies globally, new monetary systems emerged, facilitating recovery. Human resilience and ingenuity in creating and adapting monetary systems are remarkable. Money's history shows both progress and recurring patterns. We've progressed from barter to sophisticated digital finance, enabling economic development that has lifted billions from poverty. But we've also repeated mistakes, speculative bubbles, financial crises, monetary instability. Learning from history while innovating for the future remains the challenge. As you rest tonight, consider the money in your wallet or purse. Those bills, those coins, are more than metal and paper. They're embodiments of social trust, legal authority, and thousands of years of monetary evolution. The numbers on your bank statement are electronic records in databases, yet they represent real purchasing power, real economic value. This transformation of metal to paper to numbers demonstrates human abstraction and social cooperation. You work for money, spend it, save it, worry about it. Money mediates most economic relationships. When you buy coffee, swipe a card, receive a paycheck, pay rent, money facilitates these transactions. Without money, modern economic life would be impossible. Yet money is ultimately artificial, a human creation serving human needs. Money's value derives from collective belief. If everyone stopped accepting dollars tomorrow, they'd become worthless paper, regardless of what's printed on them. But we all accept them because we trust others will too. This interdependent trust creates a self-reinforcing system. Money has value because we believe it has value, and our belief makes it true. This might seem precarious, but it's worked for thousands of years across countless societies. The specific forms of money have changed, but the underlying principle, shared agreement about value and trust in social institutions, remains constant. Money works because humans are social creatures capable of creating and maintaining complex cooperative systems. The future will bring new forms of money, new payment systems, new financial technologies. But fundamental economic needs remain: ways to facilitate exchange, store value, make calculations. Whatever forms future money takes, these needs must be met. Technology changes the mechanisms, but human economic behavior's basics remain constant. Cryptocurrency enthusiasts imagine a financial system without traditional banks or government control. Perhaps this vision will become reality, or perhaps cryptocurrencies will integrate with traditional finance, complementing rather than replacing existing systems. Or perhaps they'll fade as technologies, leaving behind innovations like blockchain that transform finance in unexpected ways. History suggests that financial innovation rarely completely replaces existing systems, but rather adds layers of complexity. Central banks and governments won't easily relinquish monetary control. The power to issue and regulate money is fundamental to sovereignty. But they must adapt to technological change, global capital flows, and private financial innovation. The tension between centralized government control and decentralized private innovation will shape monetary systems' future. Financial regulation aims to balance stability and innovation, consumer protection and efficiency. Too much regulation stifles beneficial innovation. Too little regulation enables fraud, excessive risk-taking, and instability. Finding the right balance is politically contentious and technically challenging, especially as technology outpaces regulation. Personal financial literacy, understanding how money works, how to budget, save, invest, and avoid debt traps, is increasingly important but unevenly distributed. Schools often don't teach financial basics, leaving many unprepared for financial decisions. Predatory lending, complex financial products, and aggressive marketing can trap uninformed consumers in debt and financial difficulty. Improving financial education is crucial for individual and social well-being. Money affects mental health and happiness, though the relationship is complex. Poverty causes stress, health problems, and reduced well-being. Achieving financial security improves happiness, but beyond a certain point, additional wealth has diminishing returns on happiness. Extremely wealthy people aren't proportionally happier than the comfortably secure. Money matters for well-being, but other factors, relationships, health, purpose, matter more. The pursuit of money can become obsessive, crowding out other values and relationships. The ancient Greeks warned about pleonexia, excessive desire for wealth. Buddhism teaches that attachment to material possessions causes suffering. Christianity warns that love of money is the root of evil. These ancient wisdom traditions recognized money's psychological dangers even as they acknowledged its practical necessity. Finding balance, using money as a tool for living well without becoming enslaved to its pursuit, is a personal challenge each person faces. Money enables choices, provides security, and facilitates goals. But it's means, not ends. The things money can't buy, love, friendship, meaning, peace, are often what matter most. Money has enabled humanity's greatest achievements, while also enabling exploitation and inequality. The same financial systems that fund hospitals and universities also fund weapons and environmental destruction. Money is immoral, a tool that amplifies human intentions, good or bad. How we use money, individually and collectively, reflects our values and priorities. Philanthropy, using wealth for social benefit, has ancient roots but has grown with modern wealth accumulation. Carnegie, Rockefeller, and other industrialists gave away vast fortunes, founding libraries, universities, and foundations. Modern billionaires like Gates and Buffett pledge most of their wealth to charity. Effective altruism uses careful analysis to determine which charitable interventions do the most good per dollar spent. These efforts show money's potential for positive impact when directed toward social benefit. Yet wealth concentration raises questions about justice and democracy. When a small number of individuals control vast financial resources, they gain outsized influence over society and politics. Should democracy allow this? Are wealth taxes or limits on accumulation justified? These questions about money's distribution are fundamentally questions about the kind of society we want. Economic growth has lifted billions from poverty globally over recent decades. Average incomes have risen. Life expectancy has increased. Infant mortality has fallen. Education has spread. Much of this progress reflects monetary and financial systems enabling economic development. Market economies, whatever their flaws, have proven more effective at generating prosperity than planned economies. Money and markets, for all their problems, have delivered material improvements for billions. Yet inequality has grown within many countries. The wealthy have captured disproportionate gains from economic growth. Middle classes in developed countries have stagnated, while elites thrived. This creates political tensions and questions about economic systems' fairness and sustainability. Can extreme inequality coexist with healthy democracy? What policies might create more broadly shared prosperity? These debates continue without consensus. Money in politics, campaign contributions, lobbying, political advertising raises concerns about democracy's integrity. When wealthy individuals and corporations can spend unlimited money influencing elections and policy, do ordinary citizens' voices matter? Some argue this free speech that shouldn't be restricted. Others argue that money's influence corrupts democracy, requiring reform. Most democracies struggle to balance these concerns. The environmental costs of economic growth, facilitated by monetary systems, are increasingly apparent. Climate change, driven by fossil fuel consumption, threatens catastrophic consequences. Biodiversity loss, ocean acidification, and pollution damage ecosystems. Economic growth has generated wealth, but also environmental destruction. Can monetary and economic systems evolve to account for environmental costs? Can prices reflect the true costs of production, including environmental damage? Carbon taxes, cap-and-trade systems, and other approaches attempt to internalize environmental costs, but implementation faces political and economic challenges. Some propose alternative economic systems, steady-state economies, gift economies, local currencies, time banking. These alternatives imagine economies not dominated by profit maximization and unlimited growth. While remaining marginal to mainstream economics, they offer thought experiments and sometimes practical alternatives for specific communities or purposes. The circular economy concept aims to eliminate waste, designing products for reuse, repair, and recycling rather than disposal. This could reduce resource consumption and environmental impact while generating economic activity. Transitioning from linear take, make, dispose to circular models requires rethinking product design, business models, and consumer behavior. Money and finance would need to adapt, valuing durability and sustainability over short-term profit. Degrowth movements question whether endless economic growth is possible or desirable on a finite planet. Proponents argue for deliberately reducing economic activity in wealthy countries to sustainable levels, focusing on well-being rather than GDP growth. This challenges fundamental assumptions about money, economics, and progress. Critics argue degrowth would cause unemployment and poverty. Debates continue about whether sustainable prosperity requires growth or could be achieved through redistribution and different priorities. Money measurement itself is questioned. GDP measures economic activity, but is it the right metric for social well-being? Bhutan pioneered gross national happiness as an alternative measure. Other proposals include well-being indices incorporating health, education, inequality, and environmental factors. If we measured success differently, would our monetary and economic systems evolve differently? The meaning of money varies across cultures. Some cultures view money as purely practical, a tool for exchange. Others imbue it with moral significance, viewing wealth as virtue or sin. Some cultures emphasize saving and thrift. Others emphasize generosity and spending. Some prioritize individual wealth accumulation. Others emphasize collective or family wealth. These cultural differences in money attitudes shape economic behavior and outcomes. Gender and money intersect in complex ways. Historically, women had limited property rights and economic autonomy. Even today, Wage gaps, career interruptions for caregiving, and financial literacy differences affect women's financial outcomes. Financial independence is crucial for equality, yet women globally have less wealth and income than men on average. Addressing these disparities requires policy changes and cultural shifts. Race and money are intertwined through historical injustice, slavery, colonialism, discrimination, whose economic effects persist. Wealth gaps between racial groups reflect accumulated disadvantages from past policies like redlining and employment discrimination. Reparations debates center on whether and how to address these historical economic injustices through monetary means. Inheritance transfers wealth across generations, perpetuating both privilege and disadvantage. Some argue that people should enjoy the fruits of their labor, including the ability to help their children. Others argue that inherited wealth contradicts meritocratic ideals and perpetuates inequality. Estate taxes attempt to balance these concerns, but rates vary and exemptions limit effectiveness. Social safety nets, unemployment insurance, disability payments, retirement pensions use money to provide security against life's uncertainties. These programs reflect collective decisions about social solidarity and individual responsibility. Different societies balance these differently, with some providing comprehensive social protection and others emphasizing individual responsibility. Debt shapes life outcomes profoundly. Student loans saddle young people with debt before careers begin. Medical debt bankrupts families facing serious illness. Mortgage debt is required for home ownership for most people. Credit card debt traps some in cycles of high interest payments. Debt can enable necessary investments, but can also burden and constrain. The line between productive debt and destructive debt is sometimes thin. Bankruptcy allows fresh starts for those overwhelmed by debt, recognizing that sometimes circumstances make repayment impossible. Bankruptcy laws balance debtors' needs for relief against creditors' rights to repayment. Too lenient bankruptcy encourages irresponsibility. Too harsh bankruptcy traps people in permanent debt. Striking the right balance is difficult. Gambling and lotteries show money's psychological hold. The slim possibility of sudden wealth attracts millions to casinos and lottery tickets, despite poor odds. Gambling addiction destroys lives and families. Lotteries are sometimes called a tax on the poor, who disproportionately play hoping for escape from financial difficulty. Yet gambling is defended as entertainment and personal choice. The ethics of profiting from these hopes and addictions remains debated. Money laundering networks enable criminal organizations, drug cartels, terrorist groups, corrupt officials to move and hide illegal proceeds. Despite anti-money laundering efforts, billions in illicit funds flow through the global financial system annually. The same technologies that make legitimate transactions easier also facilitate criminal finance. Balancing financial privacy and efficiency with preventing crime remains challenging. Offshore financial centers, countries with low taxes and banking secrecy, enable tax avoidance and sometimes tax evasion. Wealthy individuals and corporations use these jurisdictions to minimize taxes, depriving governments of revenue. International efforts to increase transparency have had limited success. The competition among jurisdictions to attract mobile capital makes coordination difficult. as long as some countries offer secrecy, money will flow there. The remittance economy, migrants sending money to families in home countries, moves hundreds of billions annually. For many poor families, remittances are crucial income, funding education, housing, and businesses. Money transfer costs take significant percentages, reducing amounts reaching recipients. Digital payment systems could reduce these costs, helping poor families keep more of their hard-earned money. Financial crises in developing countries often involve capital flight, domestic capital fleeing to safer countries during instability. This exacerbates crises as money leaves precisely when needed most. Capital controls, restrictions on moving money across borders, can slow capital flight, but may deter foreign investment. Developing countries face difficult trade-offs in managing capital flows. Currency crises occur when speculation or loss of confidence causes rapid currency devaluation. This makes imports expensive, can cause inflation, and disrupts the economy. Countries sometimes defend their currency using foreign reserves or raising interest rates, but this is costly and doesn't always succeed. The Asian financial crisis of 1997 to 98 saw several countries' currencies collapse, causing severe economic hardship. Debt crises occur when countries can't service their debts, usually denominated in foreign currency. This can lead to default with severe economic consequences. International institutions like the IMF sometimes provide loans, but with conditions, austerity measures, structural reforms that can be politically painful and economically controversial. Debt relief or restructuring may be necessary, but creates moral hazard. If debts are forgiven, will future borrowing be irresponsible? Sovereign wealth funds, government-owned investment funds, manage national savings from natural resource revenues or trade surpluses. Norway's fund, built from oil revenues, is the world's largest, providing for future generations when oil runs out. Other countries use such funds to stabilize economies and invest internationally. These pools of capital can be substantial, influencing global financial markets. Infrastructure investment requires enormous capital over long periods. Roads, bridges, water systems, power grids require upfront investment with returns over decades. Public funding traditionally financed infrastructure, but public-private partnerships increasingly involve private capital. These arrangements can bring private efficiency, but raise concerns about privatizing public goods and ensuring affordable access. Development finance aims to fund economic development in poor countries. The World Bank, regional development banks, and development finance institutions provide loans and grants for infrastructure, health, education, and other investments. This can jumpstart development, but concerns about debt sustainability, project effectiveness, and conditionality complicate development finance. Learning what works in development remains an ongoing challenge. Microinsurance provides insurance products to poor people for small premiums. Health insurance, crop insurance, and life insurance help poor families manage risks that might otherwise be catastrophic. Traditional insurance is often inaccessible to poor people, making microinsurance an important financial inclusion tool. Mobile technology enables new microinsurance models, reaching previously unserved populations. Impact investing aims to generate financial returns while producing social or environmental benefits. Rather than pure philanthropy, impact investors accept market rate or below market returns in exchange for positive impact. This approach mobilizes private capital for social good, but measuring impact and avoiding greenwashing remain challenges. The field is growing as investors increasingly consider social and environmental factors alongside financial returns. Socially responsible investing excludes investments in controversial industries, tobacco, weapons, fossil fuels, or prioritizes companies with good environmental, social, and governance practices. This allows investors to align investments with values. Whether this sacrifices returns is debated, with some studies suggesting little difference and others finding some cost. As demand grows, socially responsible investment options expand. Green bonds finance environmental projects, renewable energy, energy efficiency, sustainable agriculture. These bonds allow environmentally conscious investors to fund climate solutions while earning returns. Green bond issuance has grown rapidly, though concerns about what qualifies as green and ensuring funds are used as promise remain. As climate concerns intensify, green finance will likely expand. Carbon markets put a price on carbon emissions, either through carbon taxes or cap-and-trade systems. These make pollution costly, incentivizing emission reductions. Revenue can fund green investments or be returned to citizens, but carbon pricing faces political resistance, concerns about economic impacts, and questions about level and design. Effective carbon pricing could be crucial for climate action, but remains politically challenging. Climate finance, funding for climate change mitigation and adaptation in developing countries, is increasingly important. Wealthy countries pledged billions to help poor countries transition to clean energy and adapt to climate impacts. But funding has fallen short of promises, and questions about what counts as climate finance complicate accounting. As climate impacts intensify, climate finance needs will grow. The financialization of the economy, growing finance sector size and influence, has been controversial. Finance has grown from supporting the real economy to becoming a major economic sector itself. Financial speculation, complex derivatives, and short-term profit focus can destabilize the economy and distort investment. Critics argue finance has become parasitic rather than productive. Defenders argue it provides valuable services, capital allocation, risk management, liquidity provision. Shadow banking, financial activities outside traditional regulated banking, has grown substantially. Hedge funds, private equity, money market funds, and other institutions perform bank-like functions, lending, leverage, maturity transformation, without bank regulation. This can increase financial system efficiency and credit availability, but also increases risk. The 2008 crisis involved shadow banking significantly, leading to calls for stronger regulation. High-frequency trading uses powerful computers and algorithms to trade securities in fractions of a second, exploiting tiny price differences. This has made markets more liquid and efficient, but raises concerns about fairness, market manipulation, and flash crashes. Rapid market plunges from algorithmic trading. Regulation struggles to keep pace with trading technology's speed and sophistication. Quantitative easing, central banks purchasing assets to inject money into the economy, was widely used after the 2008 crisis and during the COVID-19 pandemic. This unconventional monetary policy lowers long-term interest rates and boosts asset prices, stimulating economic activity. But it also inflates asset bubbles, increases inequality by benefiting asset owners, and raises concerns about eventual exit strategies. The long-term effects of unprecedented monetary stimulus remain uncertain. Negative interest rates when banks charged to hold deposits seemed impossible until recently. But several central banks have pushed rates below zero, trying to stimulate spending and inflation. This breaks conventional economic logic and creates problems for banks and savers. Whether negative rates effectively stimulate economies or simply distort financial markets is debated. Modern monetary theory challenges conventional views about government spending and debt. MMT argues that countries issuing their own currency can't run out of money and should spend freely to achieve full employment, only worrying about inflation. Critics argue this is reckless, risking hyperinflation and economic instability. The debate highlights deep disagreements about money's nature and government's role in the economy. Universal basic income experiments test whether unconditional cash payments reduce poverty effectively. Results so far are mixed, with some finding positive effects on well-being and others finding limited employment impacts. Whether UBI would work at scale, how much to pay, and how to fund it remain uncertain. As automation potentially displaces workers, UBI may gain political traction. Financial technology continues evolving rapidly. Robo-advisors use algorithms to provide investment advice and portfolio management at low cost. Crowdfunding platforms connect entrepreneurs with investors, bypassing traditional venture capital. Peer-to-peer lending connects borrowers and lenders directly. Artificial intelligence analyzes financial data, detects fraud, and makes trading decisions. These innovations democratize finance, but also create new risks. Biometric payments use fingerprints, facial recognition, or iris scans to authorize transactions, eliminating need for cards or passwords. This convenience raises privacy concerns. Biometric data, once compromised, can't be changed like passwords. Balancing security, convenience, and privacy in payment systems remains challenging as technology advances. Quantum computing threatens current cryptography securing financial transactions. If quantum computers can break encryption, financial systems security collapses. Developing quantum-resistant cryptography is crucial but challenging. The race between quantum computing capabilities and quantum-safe security will shape financial systems' future. Financial surveillance enables governments to track money flows, detecting crime and terrorism, but also monitoring citizens. China's digital yuan allows government tracking of all transactions, enabling social control. Other countries developing digital currencies must decide how much privacy to preserve versus how much surveillance to enable. These choices have profound implications for freedom and privacy. The cashless society, advocated by some governments and companies, would eliminate physical currency. This would reduce crime, tax evasion, and transaction costs. But it would also eliminate privacy, exclude the unbanked, and make everyone dependent on electronic systems. During power outages or system failures, people couldn't transact. Privacy advocates and civil libertarians oppose completely eliminating cash. Financial education remains crucial as money becomes more complex. Understanding compound interest, diversification, insurance, retirement planning, and avoiding scams requires knowledge most people lack. Should financial education be required in schools? Should governments do more to protect consumers from predatory financial practices? How do we empower people to make sound financial decisions in an increasingly complex financial world? Behavioral economics reveals that people often make irrational financial decisions, contrary to traditional economic theory's assumptions. We prioritize immediate gratification over long-term benefit. We're loss-averse, feeling losses more strongly than equivalent gains. We follow the herd in investment bubbles. Understanding these biases can help design better financial products and policies that account for human psychology rather than assuming perfect rationality. Retirement planning has become more complex as people live longer and traditional pensions disappear. How much to save? How to invest? When to retire? How to make savings last? These questions lack easy answers. People must navigate complex financial decisions with limited knowledge and competing advice. Financial advisors help, but may have conflicts of interest. The challenge of funding comfortable retirements without traditional pensions requires new solutions. As you settle into sleep, reflect on money's remarkable journey. From shells and stones to coins and paper to digital numbers, money has evolved alongside human societies. Each form met contemporary needs, then gave way to new forms as needs and technologies changed. This evolution continues, accelerating as digital technology transforms finance. Money shapes our world profoundly, yet remains ultimately a human creation, a shared social agreement. Its power derives from collective belief. When trust falters, money fails. When trust holds, money works. Maintaining that trust through sound institutions, fair practices, and technological security remains crucial as money evolves. Your relationship with money is personal and complex. Money represents security, freedom, status, power. Yet it's also a tool, a means to ends beyond itself. The things that matter most, love, health, relationships, meaning, aren't bought with money. Money can facilitate them, provide time and resources for them, but can't substitute for them. Finding balance, using money wisely, without being consumed by its pursuit, is an individual and societal challenge. Money enables choices and opportunities, but doesn't guarantee happiness or fulfillment. The richest people aren't always the happiest. Sometimes those with little live joyfully, while those with much suffer. Money matters, but how much it matters depends on perspective and priorities. Tomorrow, you'll interact with money, earning it, spending it, saving it, thinking about it. These transactions are mundane, routine, usually unconscious, but they're also participating in systems with deep histories and uncertain futures. Every swipe of a card, every tap of a phone, every number changing in a database continues money's evolution. The money you use connects you to global systems, banks, central banks, payment networks, financial markets, and to local communities, merchants, employers, service providers. These connections enable modern life but also create dependencies. When systems work, money flows smoothly. When systems fail, disruption follows. COVID-19 showed both money's adaptability, rapid shift to digital payments, and its fragility. Economic disruption when activity stops. Future money will differ from today's, as today's differs from yesterday's. Change is constant. But fundamental principles persist: trust, scarcity, acceptability, utility. Whatever form future money takes, these principles will apply. Technology changes mechanisms, but human needs remain constant. Rest tonight knowing that money, for all its importance, is ultimately a tool serving human needs. It's not an end in itself, but means to live in well. The pursuit of money can enhance life or diminish it, depending on how it's balanced with other values. Money is necessary, but not sufficient for good life. Sleep well, letting thoughts of money fade. The coins in your pocket, the cards in your wallet, the numbers in your account, they'll be there tomorrow. Tonight, you need not worry about them. Rest in the knowledge that money systems, imperfect as they are, generally work. Trust that tomorrow will bring opportunities to earn, save, and spend. Trust in systems built over millennia, adapted by countless societies, continuously evolving. Dream of simpler times, perhaps, when cowrie shells suffice for trade, or dream of futures when money is seamless, invisible, effortless, or dream of other things entirely. Money needn't dominate your dreams. Let your mind rest from financial concerns. Let the complex systems of money and finance operate without your attention. They'll function overnight, settling accounts, processing payments, moving money around the world as you sleep. Tomorrow brings new financial interactions, decisions, opportunities. But tonight, rest. Rest smarter by recognizing that money serves you, not the other way around. You are more than your bank balance, more than your income, more than your net worth. You are a human being with inherent value, regardless of money. Sleep peacefully, knowing this truth. Wishing you restful sleep and gentle dreams, untroubled by money worries, secure in the understanding that you have enough. You are enough. As your breath steadies and thoughts grow quiet, let the long story of money settle into your mind, like sediment drifting through water. For thousands of years, humans have created, adapted, and reinvented money, solving problems and creating new ones, enabling progress and causing harm. This ongoing evolution reflects human creativity, cooperation, and sometimes folly. The history of money is ultimately a history of trust. Trust in strangers, in institutions, in abstract symbols representing value. This trust enables strangers to trade, societies to grow, economies to flourish. When trust breaks down, money fails, and social order fractures. When trust holds, even the most abstract forms of money, numbers in computers, function effectively. You were born into a monetary system you didn't choose, using currencies you didn't design, participating in financial networks you didn't create. Yet these systems shape your opportunities, constraints, and choices. Understanding money's history provides perspective on its present and possibilities for its future. Money isn't natural or inevitable, but chosen and changeable. The story isn't finished. Each generation inherits monetary systems and passes them, modified, to the next. You're part of this ongoing story, making choices, how you earn, save, spend, invest, that collectively shape monetary evolution. Your generation faces choices previous generations didn't. How to integrate cryptocurrency, whether to embrace cashless societies, how to ensure financial inclusion, how to address inequality, how to align finance with environmental sustainability. These choices matter. They'll determine what money looks like for your children, what financial systems they inherit, what opportunities and challenges they face. History shows that monetary systems can be improved, that financial innovation can benefit humanity. History also shows that systems can fail catastrophically, that greed and short-sightedness can cause immense suffering. The challenge is learning from history while remaining open to innovation. Past mistakes, hyperinflation, financial crises, inequality offer warnings. Past successes, stable currencies, financial inclusion, capital mobilization for development offer models. The key is discernment, knowing what to preserve and what to change, when to trust and when to question, how to balance innovation and stability. Money reflects human values. A society that prioritizes equality will design financial systems differently than one prioritizing efficiency. A society concerned about environment will regulate finance differently than one focused solely on growth. A society valuing privacy will approach digital currency differently than one emphasizing control. These aren't purely technical decisions, but reflect fundamental choices about what kind of society we want. The power to create and control money is enormous. Historically, this power has been contested between kings and merchants, governments and banks, nations and markets. Today's contests involve governments versus cryptocurrencies, traditional banks versus fintech companies, developed countries versus developing ones. These power struggles shape money's evolution, determining who benefits and who loses. Democratic control of money, ensuring monetary and financial policy serve public interest rather than narrow elite interests, remains an ongoing struggle. Central bank independence balanced against democratic accountability, financial regulation protecting consumers while enabling beneficial innovation, tax systems requiring fair contributions while encouraging productive activity. These balances require constant attention and adjustment. Financial literacy and education are crucial for democratic participation. If only experts understand finance, then experts control it without democratic oversight. But if citizens understand money's basics, they can participate in debates, make informed choices, hold institutions accountable. Demystifying money, making financial knowledge accessible, empowers people economically and politically. Personal financial security, having enough to meet needs, savings for emergencies, freedom from crushing debt, enables human flourishing. People secure financially can pursue education, start businesses, invest in children, contribute to communities. People insecure financially struggle to think beyond immediate survival. Society functions better when more people achieve financial security. This requires both personal responsibility and social support. Individuals making sound decisions and society providing reasonable opportunities. The relationship between money and happiness is complex. Money clearly matters for happiness. Poverty causes stress and suffering. Achieving security improves well-being significantly. But beyond security, more money produces diminishing happiness returns. Extremely wealthy people aren't proportionally happier. The things making life meaningful, relationships, purpose, health, contribution, relate weakly to money beyond a threshold. This suggests that beyond a certain point, pursuing money provides diminishing life quality returns. Yet many pursue wealth relentlessly, sacrificing relationships, health, ethics in money's pursuit. Understanding money's role, important but limited, helps maintain perspective. Money is means, not ends. It enables choices but doesn't determine their quality. Wisdom lies in earning, managing, and using money well, while recognizing its limits. Generosity, using money to help others, provides satisfaction that hoarding doesn't. Research shows that people derive more happiness from spending money on others than on themselves. Charitable giving, helping family and friends, tipping generously. These uses of money often feel better than acquiring more possessions. This paradox, gaining by giving, reflects human social nature. We thrive through connection and contribution, not isolation and accumulation. Money can enable generosity at scale. Wealthy individuals and foundations fund hospitals, universities, scientific research, aid to the poor. These charitable contributions make genuine differences in countless lives, yet they also raise questions about power and accountability. Should billionaire philanthropists determine social priorities? Is private charity a substitute for public policy? These debates continue, reflecting tension between private wealth and public good. The future will bring both opportunities and challenges. Digital currencies could make finance more accessible, efficient, and inclusive. Or they could enable surveillance, inequality, and instability. Artificial intelligence could improve financial services and fraud detection. Or it could displace workers and concentrate wealth further. Biotechnology and other innovations will require enormous capital investments. Will financial systems mobilize this capital productively? The answers depend on choices by individuals, companies, governments, societies. Climate change poses existential challenges requiring enormous financial resources. Transitioning from fossil fuels to renewable energy, adapting infrastructure to climate impacts, protecting ecosystems, all require investments dwarfing most historical precedents. Can financial systems mobilize necessary capital? Can they do so equitably, not burdening poor countries and people? These questions will shape humanity's future fundamentally. As sleep approaches, let these reflections recede. The problems are real, but need not trouble your rest. You've thought about money's past and future, its power and limits, its benefits and dangers. That's sufficient for now. Tomorrow brings time enough for engaging with money in practical ways. Tonight is for rest, for letting conscious concerns fade, for trusting that systems will continue functioning while you sleep. Money will be there tomorrow, in your accounts, in your wallet, accessible through your phone. The global financial system will operate through the night, processing transactions, settling accounts, enabling commerce across time zones. Billions of people will interact with money tomorrow, earning and spending, saving and investing, creating the collective patterns we call economy. You're one person in this vast system, one participant among billions. Your choices matter, but don't control outcomes. You can manage your money wisely, but can't control markets, interest rates, or economic conditions. Acceptance of this limited control can bring peace. Do what you can. Accept what you cannot. Recognize the difference. This wisdom applies to money as to life generally. Sleep now, releasing financial worries. Whatever your financial situation, comfortable or challenging, it need not dominate your thoughts tonight. Rest in the knowledge that money is a tool, useful but limited. Rest in the understanding that your worth transcends your wealth. Rest in the awareness that money, for all its importance, isn't what makes life meaningful. Dream, if you dream, of things money can't buy. Love, beauty, connection, meaning. Or dream of abundance, of possibilities, of futures bright with promise. Or dream of nothing in particular, letting your mind wander through landscapes unrelated to finance. Your dreams are yours, unconstrained by economic reality, unlimited by monetary considerations. Tomorrow, you'll return to the world where money matters, where bills must be paid and transactions completed. But tonight, you're free from those concerns. Tonight, you exist in the timeless space between days where practical worries fade and deeper rest becomes possible. Let money's long history inform your understanding, but not burden your rest. Let it settle in your mind as background, not foreground, wishing you peaceful sleep, untroubled by financial concerns. Wishing you rest that refreshes and renews. Wishing you dreams that delight or rest so deep that dreams don't register. However sleep comes, may it be restful. May tomorrow find you restored, ready to engage wisely with money as tool and servant, never as master. Sleep well, knowing money's story continues, but needn't consume your present moment. Rest smarter by letting it all go. Good night. Thank you for listening with Sleepy Facts. Let your breath steady. Let your thoughts grow quiet. Rest smarter by allowing your mind to settle into the rhythm of night. If you enjoyed this moment of calm, you are welcome to subscribe. And if there is a topic you want to hear next, simply leave it in the comments. Wishing you a peaceful night and gentle dreams.